Hello everyone, in today's presentation, we are going to talk about the benefit and cost of Reserve Bank New Zealand proposal. The setting of capital requirement for the banking system is a fundamentally important policy decision, as this is one of the key potential tools to support financial stability. Bank capital consists of two parts. One is a capital owned by the bank, the other is a borrowing capital. Borrowing capital is a major part of bank capital, but self-owned capital is more vital. Therefore, we stand for Reserve Bank New Zealand proposal. Increase in the requirement of banks' own capital can reduce the risk of bankruptcy, but it will cause huge damage to the borrowers. Because in this context, major commercial banks are bound to raise the loan interest rate, and it would lead an increasing expense for the bank. However, the Reserve Bank side, the movement would lead to safer banking system. Although rising borrowing costs will hurt the bank's shareholders' investment returns in short term, but the Reserve Bank believes that the negative impact will be offset by the safer banking system.
The benefits of holding more of banks' own capital far outweigh holding borrowing capital. Firstly, it represents the capital ownership of the banks and the bank's ability to repay the debt. Banks must have sufficient capital to convince borrowers that banks can meet their credit needs in times of economic downturn. Therefore, enough bank-owned capital protects the depositors and increases banks' credit. Secondly, before the deposit inflow, the capital provides the necessary funds for bank registration, formation, and operation. The injection of capital allows banks to conduct business in more regions, establish new branches to meet the expanded market, and provide convenient service to the customers. In addition, bank-owned capital can meet the bank's requirement for investing in other institutions. Once a bank wants to invest in other banks, it can't use its deposits or other borrowings, and it can only use its self-owned capital.
Also, capital as a factor regulating bank growth helps to ensure long-term sustainable growth for banks. Management and the financial market require that bank capital growth be broadly consistent with the growth of loan and their risky assets. Inadequately capitalized banks suffer a reputational query in the eyes of depositors and investors, which may result into investors refraining from doing business with these kinds of banks. This shows that increasing bank capital directly leads to a corresponding improvement on banks' returns. Therefore, banks with insufficient capital growth will find themselves losing market share in the competition for large customers.
The Basel III requirements were in response to the significant weakness in financial regulation that was revealed after the 2008 financial crisis, with regulators seeking to build up banks' liquidity and limit leverage. Under Basel III, the minimum capital adequacy ratio that banks must maintain is 8%. The capital adequacy ratio measures banks' capital in relation to its risk-weighted assets. The higher ratio results the well-organized enterprise having identified the level of capital achieved soundness. Increasing soundness future if doing so can be achieved without any adverse impact on expected output. As a result, from our explanation and research, we believe that Reserve Bank of New Zealand proposing which use more their own money is more beneficial.
Thanks for watching.